Bitcoiners, hello and welcome back to your economic calendar, the news you need for the week ahead in Bitcoin. Today is Thursday and we have an excellent show for you as always. In today's show, we're going to look a bit beyond the next week. We're going to look at the next 35 days and we're going to look at three major market events that are going to hit in those 35 days. One is the US third quarter corporate earnings report season. The second one is another Fed meeting. And the last one is a US midterm election. So in today's issue, we're going to break down all those three events and how they could impact Bitcoin prices. Grab your coffees. It's going to be a good one. There are decades where nothing happens, and then there are weeks where decades happen. That's how the saying goes, and that has certainly felt true for the last few days. What happened in the Bank of England or in England and the reaction from the Central Bank of England sent ripples through the global economy and triggered a worldwide response or a global response against this orchestrated tightening cycle that central banks across the world have been carrying out for the last few months. The article on your screen, interestingly, the title of this article was changed over the last few days. Originally, the title was Bank of England Steps In to Calm Markets. And you can see that the BBC has now reissued the headline, and now it's titling it Bank's $65 billion Move Driven by Pension Fund Panic. So I guess to provide a brief summary, the meltdown in UK bonds, the British pound, and markets in general forced the UK government and the central bank to do a complete 180-degree turn on the planned tax policy that they had just announced within mere hours of the announcement. It also forced the Bank of England to have to start buying its own government's debt to stop it from spiraling downwards as buyers for that debt disappeared. And this precipitous drop in foreign sovereign bond prices almost put the UK pension industry into bankruptcy. This basically starts showing that banks are starting to run into a political wall. It appears that Britain was the first country, basically, to start bumping against this wall of tightening. And this reaction sent an ominous message to investors and regulators worldwide. Britain is the first, not the last, to experience these problems. The same will occur in other countries in a matter of time. Governments have limits as to how much pain they can inflict in a society via unemployment or via crushing asset prices before that society starts turning against said government. And if and when they turn, the outcome is not generally kind to those in power. So let's go over a few of these reactions that we are describing. So within hours of the UK crisis unfolding, several interesting things started to happen. Number one, as you can see from the headline, the United Nations calls for the Fed and other central banks to stop hiking rates on global recession fears. Number two, Bank of America warns that rates are rising too fast, too soon, and risks a large recession. And number three was that none other than Mr. Ray Dalio himself published that he now believes that the current interest rates in the United States are fair and that as it stands, cash is no longer trash. It's a big statement from a man that just months ago was saying cash is trash. And these three statements essentially say the same thing. Central banks are tightening too much, too soon, and there will be severe consequences if they continue the current course. Now, to say it bluntly, economic instability can very quickly turn into political instability. When people are angry or hungry, they become exponentially more susceptible to populist rhetoric. And this type of rhetoric tends to fuel support for parties or groups in the farthest ends of the political spectrum, which again just further fuels instability and this turns this into a vicious cycle, kind of what we saw in Venezuela. Now, while the warnings from Bank of America, the United Nations, and Ray Dalio were all very grim, markets reacted positively to the recent public pressure versus central banks. The S&P is higher by 5% this week. The yield on the 10-year note is also down by more than 5% on the same period. And this basically starts pushing back against some of the plans that the Fed had originally stated. According to Fed official Raphael Bostic, his base case remains for a 75 basis points increase rate in November and 50 more basis points in December. This has not changed at all after these three announcements came out. But what has changed is the CME FedWatch tool is now showing that investors see a slightly lower probability of that being the case. 2 weeks ago, that probability of Mr. Bostic's basic case was sitting at north of 70%. North of 75%. Today is sitting at around 65%. So investors seem to have started to question whether the Fed can actually continue to be this aggressive. It appears that the fiscal room that central banks had, fiscal room is the ability to change rates or policy without disrupting the political equilibrium. This fiscal room that they had is becoming very, very small, very, very fast. Public opinion is starting to reach a limit. We'll discuss the upcoming midterm elections and how that could impact Bitcoin markets shortly, and we'll also touch on corporate earnings in our S&P section. And now let's take another look at how another market event that's coming in the next few weeks could impact Bitcoin prices. And that is the start of the third quarter earnings reporting season for US publicly traded companies. And that starts in the coming 2 weeks. And as you know, the Fed controls the price of money and the quantity of money in the system via interest rates and the money supply. However, companies can still determine their own fate by controlling their profits and how sustainable their businesses are. Every quarter, companies report and investors basically adjust their views based on what companies report. In this environment, there are some groups or entities or sectors that benefit more than others. And a few examples of those who do benefit are groups like energy and banks. Energy has had a wonderful few months of energy prices, and banks tend to benefit in higher interest rate environments. Let's look at a few headlines for examples. Here we see that Exxon signaled that it will have strong third quarter earnings on strong natural gas pricing. Now, outside of banks and energy companies, the rest of the industries are a bit harder to determine because they have a lot of moving pieces. This is an interesting headline, went out last week, previewing the third quarter earnings season after the rough reports that have come out from Nike. As you know, Nike is the apparel company, and then Micron, which is a big chip maker. While analysts have been revising earnings targets and projections lower leading up to this reporting season, the results could still move the markets. One element that could put downward pressure on markets is the difficulty in forecasting future quarters. Typically, stocks react to the picture of the future that the corporate management paints during the earnings report call. However, in the current scenario, it is very difficult to forecast sales or economic activity with so many moving pieces. And it will be interesting to see how companies address their future guidance. Some might refrain from providing forecasts or present them with very large caveats. And the upcoming earnings season looks to be more of a risk to the downside than being a tailwind for equities, as so many pieces are moving. And again, it is very difficult to forecast. So what may be impacted, if not the earnings from these companies, could be their forward guidance. And this could put downward pressure in their stock price. Now let's talk about the third major market event that we discussed at the beginning, which is the upcoming US midterm elections. So sometimes charts do a better job of explaining a concept than words, and I think this following chart does just that. So as you can see on the chart here, I don't really have to explain it too much, but the blue line is effectively the average market behavior during midterm election years, and the gray line is how the market on average behaves every other year. Now, growing up, I remember listening to my dad during lunch talk about how he had never seen a recession during an election year. And keep in mind that this was Venezuela in the late 90s, different place, very different times now. But I always thought that made a lot of sense conceptually. Campaigning incumbent politicians, the people that are already in office, will crank up their spending to try to rally their constituents, basically to give them their support. And anybody that gets newly elected, whether it was the old guy or the new guy, will want to show quick wins or quick results. And sudden increases in spending tend to achieve both the person campaigning and the person that's recently elected. So as the chart above shows, there isn't necessarily more economic growth during a midterm election year versus all of the others. However, investor behavior patterns seem to be pretty consistent in midterm election years. Investors seem to start bidding up the market once clarity starts forming around the election results and are able to start drawing some implications from there. Now, the chart on your screen may also explain why some investors have started jumping back on the long side, albeit expressing caution and that this could be a short-lived rally. Now, while it still feels too soon to be talking about a sustained rally in the current interest rate environment, a slight change in posture from the Fed and other central banks could very swiftly change investor moods. Having said all of this, a very likely scenario is still that this tailwind from the midterm elections clashes from the hammer that the Fed is trying to hit everybody down with, and it may net out in having markets wash out sideways to end the year. So to summarize, we have 3 major market events in the next 35 days. Number 1 is the start of the third quarter earnings season in US equities, and that starts in earnest on Monday, October the 17th. The second one is the Federal Reserve FOMC meeting, which is scheduled for November 2nd, 2022. And the third one is the US midterm elections, which is scheduled for November 8th, 2022. Now, put those in your calendars. And again, we've kind of discussed how those could impact markets when they occur. Outside of those events, we do have some data and activity for the week ahead. Although it is light on economic data, we do get the now traditional Fed speeches during the week. We get 7 Fed officials hitting the stand this week. And again, it's becoming a bit of a tradition. And to talk briefly about when we can expect those speeches, Wednesday, 4 p.m., Raphael Bostic will be speaking. Thursday, 8:30 a.m., Cleveland Fed President Loretta Mester. New Fed Governor Lisa Cook will do her first speech as a Fed governor. And at 6:30 p.m., we get another speech from Loretta Mester, Fed President of Cleveland. And on Friday, we get New York Fed President John Williams. We get Minneapolis Fed President Neil Kashkari. And we also get Fed Governor Chris Waller. With that, we've reached the end of today's show. If you enjoyed the show, if you learned something, I welcome you to like it, subscribe to our channel, and share it with your friends. If you don't yet have a Ledn account, I welcome you to check out ledn.io and learn how you can start earning the best interest rates for your digital dollars, USDC stablecoins, or Bitcoin. We also have the best rates for loans backed by your Bitcoin if you need liquidity and don't want to sell your stack. And our Bitcoin mortgage lets you buy a house as big as your stack. Thank you, everybody. Have a wonderful week. And if you have any comments or feedback, please drop them in the comments. See you next time.